Welcome to this explainer. Okay, today we're tackling a massive misconception that honestly trips up even the most seasoned traders out there. You see, when you look at a standard price chart, you probably feel like you're seeing the whole picture, right? Well, the reality is you're basically looking at a mirage. That traditional candlestick chart is creating a hidden market illusion, totally masking the true forces that actually drive the market. So today we're peeling back those layers. We're going to uncover the real data that dictates whether a market is getting ready to soar or violently crash. Let's dive right in. If you've spent any time at all analyzing markets, you know this painful frustration all too well. We've all been there. You're watching the charts, the price pushes aggressively above a key resistance level, and man, everything looks incredibly bullish. It feels like the absolute perfect breakout. So you enter a long position, fully expecting that trend to just keep ripping. But then, almost instantly, the momentum completely dies. The price violently reverses, stops you out, and leaves you wondering what on earth just happened. Well, I'm here to tell you that sudden reversal isn't just bad luck. It's a highly calculated move, and if you know where to look, you can actually see it coming from a mile away before it traps you.
Section 1. Decoding the CVD Indicator.
So to stop getting trapped like that, you need a tool that basically gives you X-ray vision into the market. Enter Cumulative Volume Delta, or CVD. Instead of just looking at the surface-level price action, CVD acts as a diagnostic tool that shows you exactly who is pulling the strings behind the scenes. Now, it doesn't just measure total volume. It measures the running total of the difference between aggressive buyers, meaning those actively hitting the ask, and aggressive sellers, the ones hitting the bid. It completely ignores passive resting limit orders. Think of it as a live tug-of-war meter showing you the real-time conviction of market participants.
The math here is incredibly simple, but it is so powerful. CVD is literally just buy volume minus sell volume. When aggressive buying outpaces aggressive selling, your delta is positive, and that cumulative line is going to rise. When aggressive sellers take control, it falls. By isolating this exact mathematical difference, we are looking right past the noise. We're no longer sitting there guessing if a giant green candle actually had real money backing it. We have the exact difference right in front of us, revealing the true underlying market pressure.
Section 2. Spotting institutional divergence.
Let's contrast a legitimate, healthy breakout with a totally deadly trap. In a strong bullish scenario, the price is climbing and CVD is climbing right alongside it. That means aggressive buyers are truly driving the move. It's healthy. But then we have the trap, bearish divergence. Here, the price is rising, making new highs, which absolutely screams buy to retail traders. But the CVD, it's actually falling. This divergence is a blaring, red alert alarm that large institutions are secretly offloading their bags and aggressively selling into all that unsuspecting retail buying pressure. Now flip that script because the exact opposite is just as crucial to understand. In a strong bearish trend, the price drops and CVD drops with it. Aggressive sellers are just in full control. Simple enough, but then there's bullish divergence. Imagine the price is plummeting, maybe even breaking below a major support line, completely shaking out weak hands in a total panic. Yet, the CVD line is rising. This hidden divergence means that while retail is panic selling, smart money is actually stepping in and aggressively accumulating positions at a massive discount. They're buying the fear, and if you are just reading price, you're missing the whole shebang.
Section 3. Surviving the liquidity hunt. So why does this divergence happen in the first place? Well, it is all about how smart money actively hunts retail traders. Here's exactly how they build the trap, step by step. Step 1. Price breaks resistance. They're basically baiting the hook. Step 2. Retail traders get total FOMO and blindly buy the breakout. Step 3. This retail buying frenzy provides the exact liquidity that massive institutions need to dump their large positions without immediately crashing the price. And finally, Step 4. As institutions unload, CVD plummets, signaling the aggressive selling, and the price violently reverses. Snap, the trap is shut.
You see, institutions do this because they are the whales, or honestly, the sharks of the market. They need massive liquidity to operate. If a huge bank wants to sell a massive block of shares or crypto, they need a gigantic cluster of ready buyers to take the other side of that trade. And where are those buyers? They're sitting right above previous highs as stop-loss orders from short sellers or breakout buy orders from retail traders. Smart money purposely pushes the price up just to trigger those orders. They sweep that liquidity, feast on it to fill their own massive sell orders, and instantly reverse the market. It's a liquidity hunt, pure and simple.
Section 4. Professional CVD Trading Rules.
Consider this your institutional cheat sheet. It combines price action with CVD to give you your core signals. For a strong buy, you want to see both price and CVD rising in harmony. For a strong sell, they should both be falling. Now the divergent zones, that's where you really make your money. Bullish divergence gives you a buy signal when price falls but CVD rises. Bearish divergence gives you a sell or exit signal when the price rises but CVD falls. And finally, for basic trend confirmation, you just want to make sure CVD matches the broader price action so you can confidently hold on to your position.
Now, having a tool this powerful requires discipline, okay? There are professional, non-negotiable rules for deploying CVD safely. First and foremost, never, ever trade CVD alone. It's not a magic 8-ball, it's a diagnostic tool. You absolutely must combine it with overall market structure. You should specifically be looking for these CVD signals around key liquidity zones, like previous highs or lows, because that's where manipulation is most likely to happen. Always watch for those hidden divergences, confirm the overall market participation with traditional volume, and definitely zoom out to use higher time frames to establish the dominant trend before you even think about entering a trade.
Section 5. The CVD Advantage.
Let's rapidly recap why this tool is completely non-negotiable for your daily market analysis. Cumulative Volume Delta shields you from those market illusions by revealing the actual buying and selling pressure. It is your early warning radar. It detects smart money activity and those institutional liquidity hunts way before they fully play out. By spotting hidden divergences, you're catching reversals forming beneath the surface of the price action. Ultimately, it dramatically improves your trade confirmation, giving you the total confidence that when you enter a trade, the actual flow of aggressive money is right there backing you up.
So, I'm going to leave you with this final thought today. You now know for a fact that price charts alone can deceive you, and that institutional money literally relies on that deception to hunt liquidity. But armed with CVD, you've got the X-ray vision to see the truth. Now that you can actually see the hidden volume, ask yourself, who is really controlling your next trade? Is it you making an informed decision, or are you just liquidity for smart money? Keep studying these charts, practice spotting those divergences, and hey, please subscribe for more professional trading education so we can keep uncovering these market mechanics together. Thanks for joining me on this explainer.
Thanks for watching us. Please like, share, subscribe us.